Okay, this video is about computing the rate of return on an actual project in project finance. I've come across a lot of people who come to a modeling class, but then they tell me, oh, my job is really to kind of fill in actual numbers. And then what they do is if the project's having a good or a bad year, they put in the actuals. Maybe I don't know. I've seen people actually overwrite numbers in a financial model. It's almost unbelievable. But these are big companies too. And then what you do is if you're having a little bit of a bad year or a good year, you compute the IRR on the remaining cash flows for the whole thing and then give it to management, and it doesn't mean a damn thing. Now, if this was a normal company, you'd compute the rate of return and say, our rate of return was pretty bad this year. And I'm going to tell you why normally you can't do it in project finance. I'm going to show you how you could fix it. There's something called economic depreciation. And unfortunately, uh, so this is the same file. I use this for my generic macros explanation. And I have a little bit of examples. And what I'm going to do, I put it in IRR examples. And maybe I'm going to call this ROI in project finance and econ depreciation. I can't fit it on there. Okay, whatever. In PF, how about that? PF and econ depreciation. Now let's review some of this stuff. So I have a little thing here. Now I'm going to, I'm going to be crazy. You're going to hate me for this. You're going to give me thumbs down and bad Uber ratings and all that kind of crap. But whatever. You go to my website, the very home page, just before I put in some of those quotes from you, and then I open this file called generic macros, and I'm just going to open it. Does that work? And then and I put new versions of this thing on quite a few times. I must have been on my 10th version since I've put the new website up. Okay, so we'll open the file, and then I'm going to I suppose I'll enable editing. I hope I didn't put any links in here, and the damn thing comes to the wrong page. Oh well. Okay, it's supposed to come to this page. I better save it here for the next time. It's a read-only. I can't do that. Shit. Okay, whatever. And then I'm going to implement this. In case it doesn't show you the stuff on the bottom, you better implement it. And now let's go through this. So I made a very, very simple example. I'm going to make a very simple example with just 1,000 capex. Oh, maybe we'll put 90 of cash flow. And it seems that my formulas aren't I'm having a really shit day today. We've got 8%. That's a very good IRR because that's better than the overall stock market. Okay, and then and then what I'm going to do is show you how you normally can reconcile, which I've done before. Sorry, I'm going to repeat it. The IRR and the ROI. But the problem is the ROI isn't constant. I have some stuff about what the IRR really, really means here too, and showing you that a difference between a small IRR has an immense difference in the money you actually get to buy your grandchildren toys or houses or Lamborghinis. And then I'm going to talk about economic depreciation and demonstrate that you can compute that exact same ROI and get a constant ROI if you just adjust the depreciation, and the depreciation happens to be the change in the value of a project, which is the theory of depreciation in the very first place when you took your first stupid accounting class, and then they screw you up in accounting so bad they distort your mind, they kill your mind. I took too many accounting classes and I forgot what the real definition of depreciation. It's the loss of economic value of a project. Of course, nobody ever computes it like that anymore. But now in Excel, you can do that very quickly. It's the NPV of the future cash flows. So I'm going to go through and compute that, and then I'm going to show you. I'm going to make a pretend scenario where we have a little bit of a, let's make a little bit of a bad year, okay, and then maybe a good year after that. And then you can recompute these depreciations, and instead of computing this horrible future IRR, which means about nothing, you can actually compute uh, uh, the what's the effect on the rate of return on your project, because you use the depreciation, and instead of we this because we had a bad year, it went down, 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 up, and I didn't compute the kind of future remaining IRR. Perhaps I'll do that. Perhaps I'll get in some trouble. Now I hope there's not too much background noise because of a coffee shop, because I stayed in some really cheap hotel, which was kind of nice. It was good. We even had a bathroom and everything. Because I give away all my shit for free, so what do you expect? Okay, but I love that actually. All right, so let's start with this. So of course, what I do here is I copy this across, Shift Control R. That comes from generic macros, and it looks like we have a 30-year project. And to understand the small difference in IRR over a 30-year project, that's the key. If you don't understand this, like stupid Demera Dan who puts these silly risk premiums and this garbage, the small differences in IRR are enormous. So we had a thousand capex, and of course our cash flow is the EBITDA minus this, and of course this can also include taxes and everything else. So let's put IRR, and let's do what we should do is take the whole line. Okay, now if you compute this is so much a review. We start with our EBITDA, our depreciation. I'm just going to be horrible, and maybe I better do it like this. I better, maybe I should even do it like this. Let's insert a couple of lines, and let's make a kind of special line for our inputs, okay? And maybe I should have done this with the 90 too, okay? And then we put an equal sign, and that's 90. That's a better way to do it. And so this is the, let's, okay, let's call this one the total investment divided by the 30 years, and then we Shift Control 1, of course, and then we press F4 and we copy that. Now if you use this generic macros and open it, if I want to make a special color on maybe column F, let's make column F, I'm going to call that the sum column. It's really kind of a calculation column. And let's make our input color have some borders. Hold on, a thick line. And for now, I'm not going to include links to other sheets. I'll put some true falses, okay? And then we have that, and then so that then we see our inputs and we see our sum color. And I made a mistake. Idiot, stupid crap I am. I need to put this apply outline color. I made the mistake on purpose, and then I'm going to apply a different outline to this one. I'm going to apply medium dots to that one, okay? And then we can get our nice outline. I spent a ton of time on this crap, so whatever. It kind of looks silly, but whatever. And so now we have the EBIT, which is our earnings minus that, and our invested capital. Whenever you make a simple example like this, you kind of start with the previous number. So maybe I should put a number like this, okay? And I'm going to put this one here, and then I'm going to copy this one, and then this one is, well, actually, this one is this one minus the prior depreciation, not the current depreciation. Whoops, and then we have that. And at the very end, you should always check this kind of stuff in your project finance models. We still have a little bit, and it's the very last one. It's just going to eventually go down to zero. That's the net investment. And that's the same as the asset side of the balance sheet or the liability side of the balance sheet. Now, I'm thinking what I should do is at the end, I'm going to make I'm going to copy this sheet and leave you some blanks to do the exercise uh, uh, yourself, because my friend Elena, who once fell asleep on my videos and has invited me to make a class for her, suggested that it's sometimes good to leave some blanks. You don't have to type in all the whole thing. Now, if we use this IRR and this one, we could have a big debate about this one, whatever. If we just make an index of the IRR, that's like a present value index. And our return on capital, of course, is very low. I mean, it starts low and goes very high. That's the classic problem. That's why you can't compute the ROI. So, you know, what the heck? Let's put it here. Let's insert a spark line. Okay, and click on this one. Okay, did that work? I don't know if that's okay. That's what happens to the ROI. It goes way up. And then what we can do is put a weighting. Well, first, let's compute this invested capital, this line, but take the present value of this invested capital. So we take this number and we don't multiply it. We divide it by the this kind of discount factor. Okay, and then we compute, all right, let's compute the weighting factor, which is just taking this line, which is, again, stupid me. I'm going to finally put the formulas to automatic accept data tables. Jesus. Okay, and then what we can do is take this number divided by the sum of the entire line. That's how easy it is to compute a weighting factor. Shift Control R again, because generic macros are open. If you don't open generic macros, I don't know what to say to you. And here's what you do then. You finally put sum product. Again, I'm going to give you a whole file here of this one and the return on the investment. Okay, somebody just came in. I hope it's not going to be too loud. All right, let's put a spark line in I guess I'll use this one again. So we can see what happens to the weighting. So we put a lower and lower weight on the invested capital, and then we compute our sum product. Okay, now if you want to find this file, this is kind of stupid that I introduce it right now. You will go to Project Finance, and I'm rearranging this a tiny bit, but it's going to be other Project Finance subjects incorporating actuals. I'm also going to put it a little bit in, I'm sorry, I'm going to kind of repeat, but I'm going to put it in this depreciation section because we're really talking about economic depreciation, which is something that they should teach in accounting classes, and they of course don't. Now, in the next thing, what I did here, and let's remember how to make a spinner box. What the heck? You go to Insert, you click on a little thing here. Let's show you just. There's probably going to be a whole separate video on this, but what the heck? So let's change this by 10. So let's go from maybe 60 up to 200 and change it by 10. And of of course, use our Esri glass method. Uh-oh, there's somebody cleaning the floor. Hope that's not too loud. I hope that won't give me a bad rating. Thumbs down. Oh no, that would be so bad. Okay, then let's copy this to the to the kind of balance. Now, if you invest all your money at the same interest rate as the IRR, let's put this kind of up here. If you invest all your money at the same IRR rate, let's see how much money you make. So you make a lot of interest, and at the end, we'll put the ending money for grandchildren. Okay, and then we put an equal sign and we go all the way over here. And if this is how much money we have if we make 10%. If we just make one more percent up to 11%, we get almost double if we make, well, maybe that wasn't exactly up, but can you see? Look at the IRR and look at the money you get at the end. Screw all these financial statistics. Really, screw them all. And then if you don't believe me that that's really the number, I put a little cash flow here, and then I put a 0, and I press shift. Whoops, I didn't do that. I press shift control R, and then I go all the way to the end and say, okay, we don't. That's why I keep talking about grandchildren, because you don't get to spend it on your own little holidays or anything else. You have to just save your money. And if you just put it aside and you take this minus here and a plus here, and you invest it at the IRR itself, which is the IRR assumption, you get that much money. And just 1 second. Just 1 second. I did something wrong. This is the total amount of money you get. Excuse me. I made that mistake on purpose. And look, it gives you the same IRR. If you put equal IRR on this series, it gives you exactly the same. Now, I've had a lot of digressions here, but now let's get to economic depreciation. And here's what you do. You say, let's compute the value of the project. Now let's use the IRR. Oh, shoot. You know what I'm going to do is I'm going to, I just kind of did this quickly. And we can go up here and put a discount rate for valuation. Now, what I do, which is kind of bad, as soon as I kind of work on something, I might be a little too quick with this, and I get in a hurry, and then I said, I want to show everybody this, and I haven't thought about really what happens if you use a different discount rate yet. But we're going to use the IRR for our discount rate first. And then if you do that and you go over to here, now if you use a different discount rate, I'll just tell you, think about it, the value of your project is not the same as what's on their balance sheet. So again, that whole thing we just did was to demonstrate that to get the same value as your balance sheet. Now this isn't pure modeling, I'm sorry. Oh God, it's not just pure boring old shit modeling. It's real thinking about something. So if you put NPV and go up to the IRR and press an F4, and then take the remaining cash flows. Now, these are simple cash flows. You can do this with equity cash flows. You could do this with after-tax cash flows. You could do it with any of the cash flows. The real right way to do it would be to do it with, I'll do it, but it's the after-tax cash flows. That gives you the value of the project, okay, to all investors. And then so the value goes down, and like I've told people so much, here's my value. It's Maybe I've got 1 or 2 years left. Maybe I'm going really senile, so I'm going just here. But if you're young, your value is high. Now, if we let's put another uh, 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 um, whatever we call it, spark line, I guess is what you could call it. That's what happens to the value of your project. It's not going down on a straight line basis. Maybe we should change that to make it a line, I guess. Okay, it's not going down at all on a straight line basis. And if we look at the change in value, which is this number minus the, excuse me, it's the last number minus the current number is it. Okay, and if we add another spark line to that, okay, we'll get, we can kind of see that the change in value, which is really a reduction in value, that increases. So the change in value is dramatic at the end. Now just make this calculation. I haven't told you about it or anything. Now let's redo our EBITDA. I hope I don't have to do that. That's the same line as above. And now just take this number for our depreciation, and then the EBIT is the difference. Okay, now I'm gonna, you could delete the lines yourself and try to work through it. Or you could just do nothing, because this really, the Excel isn't very exciting at all. And now if we just want to double check the investment, of course, it's the last year's investment minus the depreciation. Okay, is the value of the project, and I should put it, I'm going to do kind of our little thing here. This is the NPV of remaining CF at the end of the period. So this one, notice I begin I begin in column K here. Do you see how I begin in column K and then L? So it's the end. It just works. All right, and then this is the current minus last year. And I'm sorry if you bitch about me not explaining this quite right. I'm trying to explain it to myself, obviously, at the same time. This EBITDA is just from above. And the depreciation is the change in value. And this is EBITDA minus depreciation, of course. And then this is just the current year minus depreciation. That accumulates, and this is the EBITDA, EBIT divided by the investment. I'm sure there are different ways, and remember, shift alternate right arrow to kind of just, oh, why does it take you up there like that? Okay, whatever. And then, so this is the, and I was wrong, minus the, divided by the prior year, okay? Divided prior. So you should do almost exactly the same thing and reconcile this in your actual model. Then I have this scenario where we say, okay, what happens if we start out, everything's fine, and we have our EBITDA, and then suddenly we have a really bad year. Our expenses go up, our revenues go down. Then we can see what happens now to the real return. You could almost say, well, this is what the IRR would have been if you, I don't know if I'm quite saying this right, let's test this, if you would have always made 80, whoops, I went too far down, then it's not exactly right because it's got the effect of the, and I forgot, what did we start with? We started with, I suppose, 120. It's not exactly the same, but it's close. Okay, that's kind of what it would be. And then if you had a good year after that, you can see what the IRR comes. And that compares to, if you don't do this, you would have to compute some sort of IRR on the project that accounts for the past and the future. I suppose I'm not even sure. You could put a minus. But again, that depends on this one. You could put a minus here and then a plus on the remaining cash flows, but you'd have to forecast that, and then you could get your own kind of IRR. Whoops, not three R's, that rolls along. Okay, I don't know, but this IRR doesn't really tell you what's really going on in the project. And if you wanted to assume that, of course, that you're going to get back to where you started with, who knows if it's merchant project, that gives you the, oh, where was our 14%? Oh, shit. Okay. Oh, God. Okay, I'm just about to stop this video. Okay. It's a lot harder to make when you're watching it. You say, oh, how obvious this was when I watch it. So this is what you would be making, but let's go back here and put a minus on that. And this isn't really the investment now, and then you can put your 180 and assume it back goes up. What does that IRR mean? What does that tell you? Or you can make a new forecast. You can say, oh no, we're going to earn 80 forever after that, and then maybe whatever, you get too low a number. Who knows? Or you can assume it goes up to 120 again. But that doesn't, the statistics really for the year by year ROIC to focus on exactly what happened this year. I'm not telling you to not do some kind of prospective IRR, but this is the rate of return that you would compute in a regular project. And it all works. I'm sorry about kind of screwing up some of those things. And I'll save this file. Again, I'm going to remind you where I saved this file. I think this idea of economic depreciation, I'm not going to say it's going to change your life completely, but it gives you an interesting way to really look at a project. Okay, it's taking too long. So again, I'm repeating, I'm going to put that right here in project finance, in building a project finance, other project finance subjects right here. Okay? All right, that's enough for that video. Made yet another video that if you watch, you wasted a lot of time on.